Welcome to Deloitte's Debrief Tax Webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and it's titled Impact of BEPS in Asia Pacific, Latest Developments and Updates. My name is Hui Beng Tan. I'm a tax partner based in Deloitte, Malaysia. I have the pleasure of hosting today's webcast. I have two speakers with me today, Jonathan Cover and Amelia Tang. Jonathan is a tax partner based in Deloitte, Hong Kong, China, and Amelia is a tax partner based in Deloitte, Australia. You may access our bios on the left side of the screen. Now, before I introduce today's agenda, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are only on listen-only mode. If you have any content-related questions, you can submit it anytime in the Q&A box at the bottom right of the screen. We'll do our best, of course, to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also, of course, explore the icons at the bottom of the screen. And if you want to download today's slides and related publications, kindly go to the downloads and links box. And of course, if you are calling from using mobile devices, you can view the slides and answer the survey on screen. Of course, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching this for at least 15 minutes. Yeah. Now, let me give you an overview of today's topic. Next slide, please. This is a very important topic for discussion today. We go for introduction and we will do a quick recap. Amelia will do a quick recap on OECD 2 pillars, OECD's implementation timeline, which we know that's very extremely ambitious, right? And John will share with us the summary concept and challenges in respect of qualified domestic minimum tax, a very important feature of Pillar 2 as well. I will explain to you the significance of implementation framework. I'll share with you what's happening in Asia Pacific, and then Amelia will share with us what's going on in the US, and we know whatever happens in US is crucial as well to the rest of the world. Jonathan will then come back to UK and share a little bit on the draft directive of EU. Okay, so next slide, please. So Amelia, could you please help us on this? A quick recap on Pillar 1 and 2. Thank you.
Thanks very much, Hui Beng, and welcome everyone to today's webinar. If we just do a quick recap on what's new, I'm sure everyone will be very familiar with the two-pillar solution by now. We've been talking about this for some time. It's obviously been front of mind for those international tax practitioners in the area for quite a while now. But unfortunately, what's new is there hasn't been a lot of movement over the last few months. You'll recall that last year we had agreement by over 135 countries and model rules were released by the OECD in December of last year, followed shortly by the draft EU directive. But here we are reaching towards September 2022 and we're still waiting for a lot of detail on Pillar 1 and we're yet to see agreement by the EU on the draft directive around Pillar 2. We've got some quite limited movement on domestic legislation of Pillar 2 and there hasn't been a lot of the promised work released on the multilateral convention for Pillar 1 or the MLI for parts of Pillar 2. So really, as Hui Beng said, the timeline is extremely ambitious as originally released by the OECD last year, and we're really starting to see some of that pressure come to bear of late. Now, you'll remember that Pillar 1 is the rule about the allocation of taxing rights. It's about who gets to tax the income of a multinational group, and it's meant to apply to the largest multinational groups. So those with a turnover of over 20 billion euro and above. And it's meant to signal the removal of digital services taxes, DSTs, around the world. Well, that continues to be a real political struggle, with the US really not seeing any pathway to get Pillar 1 off the ground, in fact. And on the flip side, as a result, we have countries across Europe, but also Asia, for example, with India with its equalization levy, being very cautious about pulling back the DSTs. So really, Pillar 1 remains in this political battlefield around how to kind of develop that as a policy which has been endorsed. Now, we have had a progress report from the OECD that was released in July on Pillar 1. In that report, the OECD maintained that Pillar 1 is still on track and that the technical rules are continuing to be pursued and developed. And in that paper, to be fair, there was a fair amount of detail in terms of the technical thinking that has been done around Pillar 1. There was some definitional work around extractives and the financial services exclusions, which clearly has been thought about in quite some detail. There was a lot of detail around the revenue sourcing. It really is quite a mechanical set of rules, and that progress report was some 100 pages, which did detail a lot of that technical work, but unfortunately we're yet to see further movement on Pillar 1. On the Pillar 2 front, that is what we're going to focus on today. I'm sure it's of interest to most in the region. There has been a little more action, most notably though it seems clear that the timeline for implementation on Pillar 2 has slipped out from the original forecast 2023 out to 2024. That's the likely kind of timeline that we're now working towards. And Pillar 2, of course, you'll recall, is the global minimum tax that's set at 15% on a country-by-country basis. These rules require domestic legislation, so even though we do have rules from the OECD released, we have model rules, which does require domestic legislation to be implemented in each country to enact the Pillar 2 rules. So it really is a waiting game to see who will go first, which country will have these in place in order for the rest to follow. On Pillar 2, what we've seen most of over the last few months is statements from countries either affirming their commitments to the policy, some consultations going on, which we'll discuss further today, and notably, draft law has been released in the UK as well, but not quite the progress that we were expecting this time last year. If we just flip on to the next slide. We won't go through this in a lot of detail, but just by way of reminder, because we are going to talk about some examples on Pillar 2 today, just a quick recap on the detail. So Pillar 2 operates as a top-up tax. It's designed to make sure that global profits of a multinational group are subject to a minimum 15% rate. This will require groups that have a turnover of €750 million and above to really assess what the effective tax rate is on a country-by-country basis around their operations, and contrast that to the 15% rate. To the extent that there is a gap, the top-up tax will be applied to the excess profits in a country, which is essentially an adjusted profit figure according to the financial accounts, and it's less a fixed-rate substance-based return for payroll and tangible assets. Now, if there is a top-up tax to be collected under the Pillar 2 model, this happens in the ultimate parent entity, or UPE, jurisdiction, and there are really two rules which support one another. The primary rule is the income inclusion rule, and that applies at the ultimate parent entity level to collect that top-up tax. If there is a jurisdiction that doesn't have the income inclusion rule enacted, then a backstop under-taxed profits rule will come into play and collect that top-up tax in an upwards or horizontal manner. In terms of the timeline, the under-taxed profits rule is expected to be delayed a year behind the income inclusion rule, meaning that countries have sufficient time to implement the income inclusion rule. Of course, the all-important topic which has been dominating the conversations of late is whether countries each have a domestic minimum tax, which I know we're going to talk through in some detail today. That really could shake that policy up a little bit. Hoi Beng, that's a quick recap. I think I'll pass back to you for a quick polling question.
Thanks so much, Amelia. That is a very useful recap for everyone here. So now that brings us to the first polling question of the day. The question is this. How closely have you been following the political development on Pillar 2? Answer the choices that you have: very closely, somewhat closely, loosely, not at all, don't know, or not applicable. This is a very interesting question here. Whilst we wait for the result of this polling question number one, Amelia, there's one question from the audience. I think I'll just get you to answer this question. Yeah. So the question is let me just read this out. I understand that there's a concern on tax incentive regime given Pillar 2, but I also understand that tax incentive regime is not necessarily dead, could still be useful because of the concept of jurisdictional blending and also the substance-based carve-out concept. Can you elaborate a little bit more on that, Amelia?
Yeah, that's a very common question, particularly in the Asia Pacific region, where we know many countries do have tax incentives regimes. Hui Beng, I think that the response to that is that tax incentives are not necessarily not necessarily over, but they are going to change. This is a global minimum tax, so I think tax holidays and zero rates are certainly going to be affected, but we might start to see more novel ways of dealing with taxes as an incentive regime. We might start to see things that are not as connected to the income tax regime being offered as potential tax-related incentives. I think that the global minimum at 15%, that as a rate has been struck as a kind of a floor for tax rate competition, and we may see some incentives that maybe sit around that rate as opposed to your traditional tax holidays and the like that have been kind of favoured in the past.
Thanks very much, Emily. I think that is a very important feedback. And now maybe I move on to the next slide. Emily, I would maybe you can share with the audience on, or to recap again on the implementation timeline by the OECD on Pillar 2. Yeah, next slide. Next slide.
Yeah, thanks. On this slide, in terms of the implementation, it really has slipped out from the original forecast by the OECD of 2023, which was obviously a very, very ambitious timeline and an ambitious target. When the inclusive framework agreed to the two-pillar solution, it was flagged as 2023. Informally now we have UK legislation, we have the UK draft directive, which were amended to now have a start date for income years beginning on or after 31 December 2023. So practically what that means is it's a 2024 start date with a push out of the under-tax profits rule to 2025. A couple of things to note on this timeline, Hui Beng, is that even though it's widely welcomed, of course, that there has been a delay or a potential deferral by a year of the income inclusion rule, because it does give companies more time to start thinking about implementation. The OECD model rules did contain a transitional rule for deferred tax items and asset transfers that really could be already applicable. So there is a start date to keep in mind of 30th of November 2021 in which those rules were triggered. So that actually extends time or extends the period in which companies are going to have to consider those transitional rules if, of course, those rules are transposed into local legislation. I think the longer that we see the delay in the onset of legislation, that becomes a very important factor. Also, of course, the onset of potential domestic minimum tax regimes around the world, the way that needs to be factored into the Pillar 2 framework itself, and whether there is an income inclusion rule adopted in countries is going to be quite important. So even though there has been a delay of the timeline through to 2024, I feel that many groups are still focusing on this with a reasonable amount of urgency because of the amount of planning work that is going towards that eventual implementation.
Thanks, Amelia. That's a good recap. I just couldn't imagine if any government in the world tries to introduce on 1st January 2023, because that's just a couple of months from now. So and that's going to be really, really challenging. Yeah. So thanks for that, Amelia. Next slide, please. Okay, this is an interesting one. Qualified domestic minimum top-up tax. I think this concept was not so prominent during the blueprint time, but there were a lot of discussion during the model rules. So, Jonathan, can I ask you to explain the concept and the challenges in implementing this? Yeah.
Sure. Thank you, Hui Beng. And I suppose I think the concept of a domestic minimum tax is probably something that was considered as possible in the blueprint originally, or at least envisaged. But I don't think it was until the rules that we of course had this definition introduced, and of course in the past year or so it's become clear just how popular the concept of introducing a domestic minimum tax is. So much so that we now of course have this definition of qualifying domestic minimum top-up tax. Because frankly, so many jurisdictions, both low tax jurisdictions, but even high tax jurisdictions, or traditionally high tax jurisdictions, effectively wish to protect their taxing rights under GLOBE by introducing this kind of minimum top-up tax. So very simply, the concept is, well, under Globe, we have a top-down approach under the IIR, and then under the UTPR, we have a kind of backup, which is, you call it bottom-up, sideways, top-down. It can apply fairly broadly. So the real concept is, if I'm a jurisdiction which might be a low-tax jurisdiction, actually it's in my interests to collect that tax myself and have that benefit my own citizens, rather than have a third jurisdiction or second or third jurisdiction collect that tax instead. Because from a fiscal policy perspective, I economically will suffer this. Groups that operate in my country will suffer this. So why not collect that tax locally? So that's the concept. Now, in terms of what a qualifying domestic minimum top-up tax is, you have the definition here up on the screen. It's basically a tax which is equivalent to the Globe rules, right? And it's to be implemented and administered in a way which is consistent with the Globe rules. So it's effectively like a domestic implementation of the Globe rules. And so therefore, it should really, from a kind of a policy perspective, it should really result in that same 15% ETR arising in a particular jurisdiction. And to the extent that taxes charged under a qualifying domestic minimum top-up tax, then that same tax should not then be again collected, for example, under an IIR, right? So the OECD have sought to cater to jurisdictions that wish to collect this tax, and it kind of effectively pushes down and localizes the top-up tax, and we'll discuss the importance of that a little bit more later. Now, interestingly, in the definition of the QDMTT, we have this bit highlighted in red on the screen, provided that such jurisdiction does not provide any benefits that are related to such rules. So what this part of the definition is intending to do is trying to stop jurisdictions from collecting this top-up tax with one hand, but then passing it back to companies with the other hand, for example. So trying to make sure that there's kind of no circularity of tax. But so that's basically the concept, and we have this definition in the rules. So if we just move on to the next slide, we can start to just explore how this works in practice. Okay, so up on the screen here, we have a fairly straightforward, two scenarios. One, where there's no QDMTT in the subsidiary jurisdiction. One where there is a QDMTT. We have a UK UPE, right? So that will be potentially collecting top-up tax under the IIR. In this situation, we have a subsidiary in Malaysia, also part of the inclusive framework. It itself also has, will therefore have an IIR and UTPR. But of course, under the top-down approach, it is the UPE who has the right to collect top-up tax under the IIR. So if we look at scenario one, UK Co will pay that tax to the HMRC. And in Malaysia, even though kind of economically, tax is being paid in respect of Malaysian profits, there'll be no tax collected at that level. Now, if we look at scenario two, this is where Malaysia has implemented a QDMTT, and so this this pushes down the taxing rate effectively into Malaysia. Right? So instead of that top-up tax being collected by UK Co under the IIR, instead, Malaysia effectively has the first bite of the cherry in terms of tax. It should compute that 15% tax effectively in the same way as the Globe rules, and that will be paid over to the local Malaysian tax authorities, right? So it's a kind of an inbound scenario into an Asian jurisdiction with low tax. So if we go on to the next slide, we have the outbound scenario, right? So it's really effectively illustrating a similar concept, but now it's just an outbound. So we have a Malaysian headquartered company, right? We assume that there's significant profits in that Malaysian company in the headquarters that have a low ETR. Now, if we look down the chain, the ownership chain, we see Singapore Co, Hong Kong Co, both part of the inclusive framework again. Under the IIR, they can't collect tax because Malaysia is the UPE, so top-down approach prevents them from collecting tax. But the UTPR would allow them to look back up to Malaysia and for tax to be collected at the Singapore and Hong Kong level in respect of the profits of Malaysia. Right, so if we look at scenario 2, what we see is Malaysia has basically implemented its QDMTT in that scenario, and so tax again will be collected in Malaysia and paid over to the Malaysian tax authority. So we see the QDMTT having a kind of a dual function when we have kind of inbound into an Asian subsidiary jurisdiction. QDMTT can act against top-up tax being collected. Exclusion rule, where we're in a kind of outbound scenario with here we have a Malaysian reported company. We have the QDMTT protecting against top-up tax, which would be collected under the UTPR. Right. So there's kind of a dual purpose here, and it's quite when you look at the policy design of the QDMTT, it's worth considering what's being protected against, right? Is it top-up tax under IR or UTPR? Now, broadly, the QDMTT obviously does both, but the timing of the introduction of the QDMTT might mean there's some variance in terms of its how it kind of applies, I suppose. So let's explore that a little bit more on the next slide and some of the policy considerations. Okay, so let's start here with the incidence of tax, because I think this is quite an important point, which probably doesn't get a lot of airtime really, and under the IIR, which I suppose is the primary rule in the global, which we expect to collect top-up tax. A lot of groups tend to look at the globe exercise as a kind of a top-down exercise, right? Something to be very much administered from the head office jurisdiction. But in reality, because of the significant proliferation of qualifying domestic minimum top-up taxes, what you're actually likely to see is that the charge to tax in many scenarios will arise in the low tax jurisdiction itself, right? So it'll effectively be pushed down. So while a project may be run on a M&E kind of group-wide basis, for example, the global CFO, global head of tax, should rightly be interested in the outcome of that exercise. Actually, a lot will be administered locally as well. Okay, so there will be a local QDMTT, or the QDMTT rules should be equivalent to the globe rules and should give rise to consistent outcomes. There could be some degree of local variation that exists as well. Similarly, the legal obligation, right? The legal obligation on a particular company will be locally, right, as opposed to being a top-up tax on the UPE. So in terms of kind of a project governance structure, it's really important that people understand that and understand that there is a local obligation. You perhaps will want to have local resources that understand the tax. There's also a question of how the QDMTT interacts with domestic law, right, and particularly things like general anti-avoidance rules, right? That'll be really important, and we can discuss that a little bit later. Timing. Okay, so there is a timing of the QDMTT, and that becomes really relevant in the context of an outbound situation. So Malaysian headquarter group, a Hong Kong headquarter group, which is a low tax jurisdiction. Okay, so in those situations, the QDMTT, if it comes into effect the same year as the IIR, then it could lead to a higher overall top-up tax burden than if the QDMTT comes into effect at the same year as the UTPR. Okay, so this is assuming a 1-year delay between the IIR and the UTPR. So there's going to be a question for some jurisdictions as to which year they intend to implement the QDMTT. So, for example, I understand that in Switzerland, they're likely to implement the QDMTT in the same year as they implement the IIR, whereas other jurisdictions, perhaps like Hong Kong, there might be more likely to be a delay. So the QDMTT is perhaps implemented 1 year after the IIR. And this is, of course, because IIR does not apply within the jurisdiction of the UPE, right? And there's perhaps some exceptions within Europe, but the general matter, the IIR doesn't apply within the jurisdiction of the UPE. So if you're a low tax jurisdiction, UPE, the timing of the implementation of the QDMTT is important as well. And one of the other interesting kind of policy considerations is CFC interaction. Now, of course, CFC taxes are generally treated as a covered tax under the Globe rules. And so, you might think that CFC taxes should be treated as a covered tax for the purposes of a qualifying domestic minimum top-up tax, and therefore also reduce the amount of top-up tax that should be paid. Right now, I think under a strict reading of the Globe rules, a literal reading, that is exactly what they say, right? CFC is a covered tax. But I understand there is a kind of ongoing policy discussion, particularly among some of the lower tax jurisdictions that might implement QDMTT, and in respect of which some of their profits might be subject to CFC tax as well. If they reduce the amount of QDMTT that's payable as a result of other jurisdictions' CFC taxes, that really means that low tax jurisdiction isn't collecting the minimum amount of tax that's envisaged under these Globe rules. And so there's a little bit of a question of fairness there, really, from an overall policy perspective, as some of that kind of CFC tax will effectively be collected by a parent jurisdiction. So that's more of a policy one, and something which I think we'll see develop in the coming months, and perhaps get more clarity on the implementation framework. But I think the key message that I want to convey about these QDMTT is that they seem very simple, and I think people think, well, it's really just a copy of the Globe rules, and isn't that very straightforward? But actually, there's quite a lot of policy decisions for jurisdictions to consider, and there could be quite a number of thorny issues that come out in practice when people start to really implement a QDMTT. So, Ho Bang, with that, I mean, maybe you can talk us through some of what we anticipate seeing in the upcoming implementation framework.
Yeah, thanks, Jonathan. Right, so we know that the implementation framework will be subsequently issued. It's expected by year end, but if not year end, then probably early next year. So this has really its own importance, and I'll just share what are the things that ought to be covered and expected to be covered under the implementation framework next. So we expect a number of things will be covered. First of all, in terms of safe harbor rules, the rules under Pillar 2 are extremely complex. All of us know that runs to hundreds of pages, right? So, and one of the consideration is, certain safe harbor rules. For example, can we use a CPCR, ETR as a starting point? Any adjustment needed for that? There was also some discussions on whether we could use one jurisdictional ETR for a couple of years. Those things that are being considered. Obviously, there are a number of considerations for that. And then we expect the implementation framework would also cover agreed administrative guidance, which is important. It will ensure consistent implementation of Pillar 2, guidance on, for example, application on shared assets, shared personnel across jurisdiction. How do we deal with that? How do we calculate the substance-based cover based on this situation? So we expect that to be clarified. One of the important aspects of the implementation frame would be in terms of the return itself, the globe return, right, which is supposed to be filed by the UPE in the UPE jurisdiction. We expect that there will be a standard template should be provided. What are the data that's required? I think all those are important. And obviously, taxpayers, those affected MMEs will be very keen to understand what is really required, because with that they could then start to think how to automate the accounting system with a view to generating proper data for that. Then we also expect that implementation framework will cover things like bilateral and multilateral models for the qualifying competent authority agreement. So that's very important. Just to recap, the proposal under the pillar to the model rules. I say the model says essentially the UPE will file the globe return to the UPE jurisdiction, whereas in a situation where there's an exchange of information situation, the constituent entity would just need to notify the tax authorities in that particular jurisdiction. In absence of the exchange of information situation, then the constituent entity is expected to file a copy of that return to that relevant authority as well. So really the mechanism, for this is very important, and will probably be laid down nicely in the input. Right, so let's move on to the next slide. Okay, actually this brings us to polling question number 2. So let me just read out. These are the questions. How familiar are you with the globe rules? The answers will be option 1, very familiar. I've been thinking about it and modeling how these rules apply to my company. Somehow familiar, somewhat familiar. I've skimmed the rules, but I've not dug into the details. Not familiar. I've heard of the globe rules, but I've not looked at them. I don't know or not applicable. So very nice questions with all the practical options. So whilst we wait for the answers for this survey, John, there's one question on QDMTT. Let me just read it out. Probably some of the you have answered that a little bit on that, but I'm just going to read a bit. I think it's an important question, John, for you. Given the importance of QDMTT in protecting the revenue base of a jurisdiction, would there be any reason for any inclusive framework members not to introduce QDMTT? That's question number 1, and there's another question following that. Also, do you think that many UPE countries will start to consider introducing CFC regime so that the UPE countries will not cede their taxing right to the QDMTT jurisdiction? Maybe you can help on that, John?
Yeah, it's an interesting one. I think it's hard to really see a good reason as to why a QDMTT, in a targeted sense, which just applies to companies that would in any way, in any case, be affected by the globe rules. It's hard to see why jurisdictions wouldn't implement this kind of rule. Except perhaps where they feel like the top-up tax will be so minute that there won't be any benefit. But we see jurisdictions like, for example, the UK or other very large economies and high tax jurisdictions also looking at the QDMTT. So I think there's really no clear reason why some jurisdictions would not implement one. Although I think that doesn't mean all of them will. In terms of CFC rules to kind of counter a QDMTT, I think that's quite an interesting question, and I think it's definitely a lot less obvious of a path for a jurisdiction to take than implementing a QDMTT. So I think if jurisdictions were to look at implementing CFC rules, I think they'd have to have a very close look at the globe rules themselves and consider the spirit of the CFC rules so I'm not sure we'll necessarily see a proliferation of CFC rules, but certainly QDMTT is very likely.
Thanks, John. It's It's a question with a difficult answer, yeah, but from the policy perspective. So thanks for that. So Perry, do we have the result for polling question number 2? Right. So yeah, the majority says somewhat familiar, skim through the rules, but have not gone through the details. As they say, the devils are really in the details, isn't it? Right. So we really got to look into the details, I guess. All right. So I will move on to the next slide. I'm going to share with you what is happening, what's going on in Asia Pacific, right? So the audience today will probably be very interested to know what's happening here in this part of the world. Next slide. So there are a couple of questions, or survey questions that we've done with my colleagues around Asia Pacific. First question is, any announcement on the date of implementation of Pillar 2? Second question, John has touched about that just now. What was happening to QDMTT? Will that jurisdiction introduce QDMTT? That's question number 2. And question number 3, of course, is about incentive. What is the government of that jurisdiction going to do with the existing tax incentive? As mentioned earlier, as Amelia explained earlier, tax incentive is not necessarily there for a few reasons. So let's look at what people are looking at the moment, right? So we surveyed a number of countries. For example, in China, no official announcement as yet, but that doesn't mean they're not doing anything. They're quite prepared. They understand the rules. But probably adopting a general wait and see approach. Now, those that you have star in blue, something that we probably have to be a bit more careful on that. On Hong Kong, maybe John, you want to just tell us a little bit more on Hong Kong, given that that their star rating there?
Yeah, sure. I mean, Hong Kong had previously made an announcement of introducing the global rules and planning to introduce a QDMTT. In the last couple of weeks, it's been clarified that Hong Kong will push back its global implementation to 2024, and it's leaving the timing of the introduction of the QDMTT to be determined. Right? So I suppose it could be 2024 as well. It might be 2025. I think they'll look to places like the UK, Europe, etc., to see their timing of the introduction of the UTPR, and then they'll probably coordinate the QDMTT to defend against the. So, we've got a bit of timing and uncertainty, but that's the latest out of Hong Kong.
Yeah, thanks, John. Thanks. I remember Hong Kong was one of the few jurisdictions that made some statement on Pillar 2 together with Singapore. So good to know that is a bit more certain right now. In India, no official announcement, but was made to understand that for QDMTT, India thinks that it's unlikely in this situation because they believe their tax rate is anyway above 15% most of the time. So in Thailand, no official announcement, but be assured that the revenue there is aware of what's happening, trying to wait for the neighboring countries to understand what the rest are doing. Likewise for Vietnam, no official announcement as yet. In Singapore, no official announcement, but they did make it clear during the recent budget, that they're adjusting their tax system in response of Pillar 2 global rules. And of course, Singapore did mention that they are considering QDMTT as well during the recent budget a couple of months ago. Have not really mentioned anything about tax holiday, but I understand that tax holiday are meant to stay. Right? There will still be tax incentive regime in many countries in this part of the world. Right? Now, let's move on to the next slide. We also surveyed New Zealand and a few more countries. For example, New Zealand, no official announcement yet at the moment, but there is some public consultation we'll explain to you shortly. Interestingly, Malaysia, where I'm based at, a small country, it has announced that it will implement Pillar 2. That's quite a bold statement, isn't it? And it did announce that it's considering QDMTT in just recent weeks, right? So tax holiday, no official announcement yet, but be assured, I think the tax holiday is meant to, it will remain. Now to Australia, maybe Amelia, could I ask you to just explain a bit more on Australian situation right now?
Sure. In Australia, we're really a keen participant in the inclusive framework. Of course, all of these countries that we have on these slides have endorsed the OECD's principle for the two-pillar solution. So it's interesting that we're yet to see kind of too many official announcements. Australia did have a new government elected earlier this year, and so it definitely had bipartisan support, and there was election commitments made to complete or implement the global solution in line with the global actions. So it's kind of a cautious statement. It's not an official announcement, but there's certainly an expectation that Australia will follow the pack in respect of the Pillar 2 rules, but we're yet to have any formal announcements around the date of implementation, Hui Beng.
Thank you, Amelia. That's helpful. Now, on Japan, no official announcement yet, but you be assured again, the NTA is definitely aware of what's happening. And in Indonesia, there's a very interesting statement by the government that it's ready to implement Pillar 1 and 2 in 2023. Well, I mean, it's ready, but whether it will is a separate matter. And just, I think most of us are aware that Indonesia currently is the chair for G20, and obviously they have a little bit of pressure to ensure that they are seen as a full supporter of Pillar 1 and Pillar 2. So it did mention it's ready, but remains to be seen whether at all it will be done in 2023. So something for us to continue to monitor. Right, next slide, please. Now, having shared with you what's happening in Asia Pacific, in this part of the world, at least two countries have issued public consultation in regards to globe rules. Number one is New Zealand. So on 5th May this year, the Inland Revenue Department of New Zealand has issued a public consultation paper. Obviously, there are a number of questions that have been raised by the IRD. The public consultation does demonstrate that the government in New Zealand is pretty serious in looking at this. So hence the consultation paper. What was covered in the consultation paper, a number of things. Of course, we can expect the basic things like whether New Zealand should adopt the rules, that is expected. Question number 2, obviously QDMTT, the important subject matter today, whether QDMTT should be introduced. And interestingly, New Zealand government mentioned about QDMTT in respect of inbound and outbound situation. And of course, New Zealand also asked about what are the safe harbor rules that should be considered, and a few administrative aspects, right? So now I move on to the next slide. Malaysia, albeit a small country in Asia Pacific, on August 2022, issued a public consultation paper as well, the Ministry of Finance. There are 23 questions in the public consultation. Similar question have been asked by Inland Revenue of New Zealand has been asked. And one important point is that Malaysian government was asking what should be done on the current tax regime in Malaysia. So obviously the government is really looking at this as well to see, what's the best way to deal with that to make sure Malaysian incentive remain relevant. And being based in Malaysia, I can tell that the tax holiday in Malaysia will remain with some modification probably, but it's on a case-to-case basis. But I can tell that the tax holiday will still be there. Right? Okay, let me move on to next slide. Okay, so Amelia, maybe you can help us on what's happening in the US, because I think this aspect is quite important, may impact the rest of the world. So Amelia, on US.
Sure, lots and lots of interest in what's happening in the US. Obviously, a lot of US multinational groups and their subsidiaries very focused on what will the impacts be, and also obviously what will the compliance kind of outcomes be. For the US, it really has been a tough sell to get this policy up and running. The Biden administration, of course, did propose changes to the existing US GILTI regime and its Build Back Better package earlier in the year, with the intent to increase the GILTI rate and to switch from a global blending basis to a country-by-country basis. Obviously, that was a proposal that was intended to bring the US GILTI regime more in line with the OECD's Pillar 2 proposal. And as far as July this year, President Biden was stating that the US is committed to that deal. But politically, they haven't been able to achieve that with the Senate that they have. There's been a raft of political negotiations around the spending proposals, and they really haven't been able to get the Pillar 2 kind of reforms through or adjustments and amendments to the GILTI regime, let alone even talking about a law for Pillar 1. At the end of last month, the reconciliation package was enacted, and it was signed into law in the last few weeks, actually, in the US. That was the Inflation Reduction Act, which does include a minimum corporate tax rate of 15%, but it shouldn't be confused with Pillar 2. So I'm told that that's not relevant to the Pillar 2 global minimum tax proposals that were in the Build Back Better package. So really, the political landscape of the US is looking like it's very difficult for there to be an enactment of Pillar 1 or Pillar 2 or any adjustments to the GILTI regime. So where does that leave the US? If we flip onto the next slide, there's been really three kind of possibilities which have been discussed in relation to the US and the interaction with other jurisdictions' Pillar 2 rules for a little while now. The first scenario really looks to whether or not the GILTI regime or the US would have a law which would be considered to be a qualifying income inclusion rule. Now that scenario doesn't look very likely now, at least in the near term, where the US GILTI will be considered to be a qualifying income inclusion. Now the benefit of that obviously is that if a country does have a qualifying IIR rule, then the subsidiary jurisdictions are essentially switched off in terms of a compliance obligation or a filing obligation. Now that doesn't necessarily take into account the fact that we have a proliferation of QDMTTs, but as originally conceived, if a country in the UPE jurisdiction implements the IIR, that is the country which is intended to have kind of carriage of the administration and I guess most of the bulk of the work in relation to the GLOBE rules. The scenario 2 that is on the slide in the middle there revolves around GILTI being unchanged and therefore expecting to not be a qualifying income inclusion rule, but the CFC taxes or the taxes that are collected under a GILTI regime not being considered to be a good Pillar 2 tax. Now this goes to the heart of that issue that Jonathan was talking around earlier in terms of allocation of CFC taxes. Really, it's not about whether or not there is collection of tax in a global sense, but which country is collecting the tax. And that second scenario really is one of the kind of the worst practical outcomes for a US multinational, because that is potentially leading to two systems working in tandem and not really interacting at all, and potentially having the risk of double taxation. The third scenario is, I guess, the kind of maybe the place where we would like to be in a practical sense if there are no changes to the GILTI regime. The third scenario would respect that the GILTI regime is a tax which could be considered to be a good CFC tax for Pillar 2 purposes. What that would mean is that the mechanics of the GLOBE rules could be used to allocate those taxes which are collected in the US down into the individual subsidiary country jurisdictions when computing their ETR for GLOBE purposes. It should mean that there is less of an impact in terms of the collection of taxes. However, it would have many questions around the allocations and some of the mechanics around how those two sets of rules would interact. So if we just flip on to the next slide, we have a few examples to try and just tease this out and to explain this in a kind of a simple sense. In this example, you can see that we have a US parented group with operations in a number of countries. In 4 countries there, we have 3 CFCs and we have a disregarded entity in country B. Now, 3 of those have low tax outcomes, but there is an application of the IIR or UTPR under the Pillar 2 rules in country C, so applying to CFC 2. Now, this is the scenario probably there, where we'd all, I guess, like to be in the event that the US doesn't implement its own Pillar 2 rules, where the GILTI is treated as a good CFC tax. Now, the mechanics of how this should operate is that the US parent level does in fact recognize that there is a tax that might become payable under the GILTI regime. It would pick that up under its existing worldwide blending and with the rates that it has in place. but those taxes could be allocated to the individual jurisdictions when computing the ETR for the individual countries that are required to apply the Pillar 2 rules. So what that means is that even though there is a potential incidence of tax in country C, either under the IIR or under the UTPR for the profits of CFC1 in this example, or perhaps other entities within the structure which are sitting in the group which have a low tax outcome, even though there is an incidence of that tax, there would be a reduction in the overall computation of that amount so that there isn't a double up. Now, definitely the allocation of these taxes would be an issue in terms of timing as well as the method of allocation, given that the GILTI is a worldwide blending regime, whereas the Pillar 2 rules operate on a country-by-country basis. There's certainly some open issues about how those mechanics would work. There's also some very real questions that US multinationals would be looking at the moment in terms of whether or not any taxes which were collected under the IIR or UTPR by country C in this scenario, whether they would be creditable in the US. So there's certainly some real practical kinds of questions, but this scenario would at least enable, in principle, for there to be no double tax. If we compare this to the next slide, just briefly, we'll just contrast that example to the situation where the GILTI regime is unchanged and is therefore not a qualifying IIR, but the GILTI is considered to not be a good CFC tax for Pillar 2 purposes. So in that scenario, I guess what would happen is that the GILTI regime would apply as it does currently. The US parent would collect the relevant level of GILTI taxation, but then the Pillar 2 rules would also come into play for the CFC2 in this scenario in country C. So that means an additional layer of tax under the IIR and the UTPR without respecting the tax which has already been collected at the US parent level. Now, certainly that gives rise to these questions around creditability, but obviously also gives rise to questions around double tax. And certainly for US multinational groups who are looking at the way that these rules are developing and potentially being enacted around the world, this is front of mind at the moment in terms of a kind of a practical outcome. I guess it really comes down to the modelling of these outcomes and the push and pull around which country might have the rules at what time. Probably one of the countries, I think, which is the front runner is the UK. Jonathan, I think I'll pass it to you to maybe walk through what's happening in the UK.
Yeah, sure. Thank you, Amelia. So in late July, the UK published some draft legislation for consultation. Now, why is that important on a debrief that's focused around Pillar 2 and Asia developments? Well, it's important because the UK is really perhaps the first major developed economy to publish draft legislation on GLOBE. And so, looking at their approach, we can glean some insights into how other jurisdictions might be tempted to draft their own legislation, particularly as the UK is a fairly well-respected jurisdiction with regard to tax law. So I think the first interesting thing to note is that really the draft legislation absolutely was not a cut and paste of the OECD Pillar 2 rules, right? It was there was a significant amount of redrafting, reordering, and there was also a reasonable amount of commentary that was incorporated into the law itself. Right? So for example, around the transfer pricing provision, some of the commentary was effectively rewritten into the rules themselves. So as a kind of a starting point, we already see quite a significant amount of divergence in terms of the rules. Now what are the rules themselves from an overall perspective? They're very much consistent with the GLOBE rules. We do see clearly that the UK has taken its own approach and has kind of drafted the rules in a way which makes sense from its perspective. Now, in addition to that, I suppose rewrites and the incorporation of aspects of the commentary and the rules, we also see the weight and importance given to the commentary. So the commentary basically being described as a part of the GLOBE rules, right? And so it's clear that the commentary, and of course we know this from other discussions with IF but the commentary itself is not really guidance. It's not to be viewed as kind of sort of second tier to the law, but it's to be viewed, of similar significance to the primary law itself, but just giving further detail and complexity. So there's several hundred pages of commentary are significantly important, and there's also a mechanism in the UK draft legislation to allow the legislation to move with the commentary as that's updated. So I think that is interesting too. But perhaps one of the other interesting developments, again, which is likely to be viewed by some of the Asian jurisdictions, and it's worth noting that this is, of course, draft legislation under consultation, but the UK made their draft legislation subject to their general anti-avoidance rule. So that's important because if we think about the nature of the globe rules, right, as rules that apply to an M&E group that spans, often many jurisdictions, where a group is, or where we have general anti-avoidance rules as part of these globe rules, each jurisdiction tends to have a different general anti-avoidance rule. So then there becomes a question as to whether we have to apply the harshest general anti-avoidance rule, whether we apply the general anti-avoidance rule of the UPU. And of course, as I mentioned earlier, when we look at QDMTT, right, that's when we have to ask this question again, because we then might say, well, does that also mean that QDMTTs will be subject to general anti-avoidance rules potentially as well? Right? I say potentially because even these UK rules are draft rules, so still subject to development. But we can see the potential for complexity, right? Where we have OECD rules, we then have a local implementation in a large UP jurisdiction like the UK that does have many multinationals headquartered there, and will then have QDMTTs, which then might be another very, very similar set of legislation, but there still might be some nuance. In terms of the UTPR, planning of that and the design for the UK will be determined at a later date. So that that suggests that there's some uncertainty internationally as to when the UTPR might be implemented, and of course, probable implementation, but no decision there. Well, so we wait with bated breath to see the outcome of the UK consultation, and it looks like we'll be able to glean some insights as that process develops as well. So, Hui Bang, perhaps back over to yourself just to close off on the EU directive.
Yes, thanks, John. So let's move on to the last part, the EU draft directive. So we know that it was issued in 22nd December 2021, a couple of days before Christmas, a few days before Christmas. So this is a very important, document. It's a significant. There's one significant change in the model rules compared to the model rules. Income inclusion rule, the IRR applies to entities in EU parent jurisdiction itself. So this is quite a big difference compared to the OECD rules. And of course, as I mentioned earlier, EU says that they will apply, IRR from 31st December 2023, effectively 1st January 2024, and under tax profit rules, 31st December 2024, so effectively 1st January 2025. So that's what they plan to do, and UK has done that as well. So this EU directive is quite a important guidance to the rest as well. Yeah. So to all the audience, I mean, unfortunately, that's all the time we have today. Jonathan and Amelia, thank you so much, and a special thanks to all of you who were able to join us. We would like to encourage you to fill up the short survey that will pop up on the screen momentarily, and tell us what you think about today's program. If you join us late, not to worry. This presentation will be archived for future viewing. And if you feel that others would benefit from this important topic, share the webcast via share this icon, and and have them visit the brief website. We will, of course, try to respond to all questions submitted during the webcast in a couple of weeks. And if you think of any other questions or comments later, feel free to reach out to me or our speakers. We'll be more than happy to talk to you. Last but not least, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye for now.